taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
All right, we're back with another week that was April 29 to May 3. I didn't say welcome back.
Good work.
Good work.
So you know, Steve.
Innovation.
Didn't trigger Steve this time. Well done.
Don't be predictable.
Oh, I won't. All right. Here with Jacob and Steve. What we're going to be covering off today is week that was April 29 to May 3. And we're going to be going through election influences. The walls are going up. Total returns roller coaster. Apples ain't apples. Sell in May.
You like that one?
And some April outcomes.
Apple ain't apples. You like that one?
Oh, I read it wrong. Apples ain't apples.
That's what I said. You've just killed the bloody joke.
I did.
That's it.
I'm sorry, mate.
No, it's all right. I'll rip it again when we talk about it.
All right, just starting off with the big issue. The dominant economic issue for the past 12 months anyway has been that the level of US government spending currently running at about 6% of the GDP. And in the United States, that is a lot of money.
That is a bucket load of money.
Well, look, most economists freak out, right? And they start screaming about rising interest rates, which they believe will cause a recession, hence all the now incorrect calls for a 2023 recession. But instead, the US just keeps
banging along. Well, that's why I think I might have said it in the recording for the week that was, that's why I'm a bit harsh on economists, because they make all these predictions and they're just bullshit. They never work out, but they just keep making predictions. I mean, you know, what other field, if the doctor said, yeah, you've got this and it's got it wrong, and then, no, you've got this, got it wrong. No, you got this, you got it wrong. You'd go, I'm not listening to this bloke anymore. But these guys are just trotted out every bloody week to tell us about the economy, and they're wrong.
They just keep saying the same thing till they're right.
And you're right. And you're right here. They could have just picked up the phone, asked you, and
exactly.
Then it's that easy.
It would have.
And I'd have said to them, you know,
you're wrong.
Here's what's going on. But we look, in our defence, ours, not my defence. You know, we have been talking about that a while ago, because this is that thing about theory and prac, right? All these guys are always talking about economic theory, and that's why we're saying, guys, that's not the way it's worked. But you see, they always come up with some bullshit excuse about what went, you know, look, the recession talk, right? They're all going, oh, it's going to be a recession. You know, why? Oh, well, interest rates are rising. That's going to cause a recession, and government spending, oh, well, that's going to be raging inflation. Wrong. And so they get it wrong, but then the caravan moves on, right? They just go on to the next thing. And that's why I say, why would you listen to them? You know, they were all, remember in COVID, right? They were all like, oh, well, rates are going to stay low until 2024. Wrong. And wrong rates went from 0.1 to 4.5.
Like that.
Well, yeah, but, you know, it's not like they were a little bit wrong. They were like completely wrong. But apparently we're supposed to, you know, listen to these blokes tell us how we need to run the economy.
To be fair, though, we have been conservative for a while, based on valuation.
Yeah, but this is more aimed at the economy, you know. So that's why I'm a little bit critical of them, because they look at the theory, and it's what you're talking about, Tom, with valuation, right? Everybody in finance theory says, oh, that CAPE ratio's bullshit, you know. Don't listen to any of those stuffs about timing the market and stuff. And then when you look at the history and you look at the reality, you go, oh, actually, valuation is really important. But it doesn't suit them because it's not in the theory, and so therefore they don't talk about it. But they keep getting it wrong. And that's where my criticism is, guys, people are depending upon you to manage their money. And you know why we end up with piddling 2% real returns? Because they listen to people like you. Right, buy and hold, and don't worry about this. And like in the last episode, oh, yeah, just keep buying the dip, you'll be right. And it's like, no, that's not the way it works, right? But
yeah, I mean, look, it's likely we're in an election year anyway. We spoke about that a few times. It's unlikely it's gonna take a dump
despite the high valuation, government's probably going to do whatever they can to
absolutely
keep things propped up, right?
Yeah. Well, particularly in the US, and it's the biggest elephant in the room. So if they keep spending more money, everybody else is going to love it. The only thing I'd say to that is what you're seeing at the moment is a lot of currency fluctuations between the Chinese yuan, the Japanese yen, and the US dollar. And we don't talk about that much. But what I think is going on is as the countries, when they want to export, they keep their currency cheap, right? So, it becomes cheap to export a lot of stuff. Now, if the US says, listen, we don't want that stuff anymore, or we're going to put a tariff on it, the response is generally to go, okay, well, we'll just lower our currency even more to negate the tariff, right? What I think we've got going on at the moment is because we're moving to this more protectionist regime, particularly in the US, what you're seeing is a lot of these countries are trying to drop their currency to maintain their market share, right? Because they're all manufacturers. So, you guys are too young, but in the 80s, it caused, heaps of upheaval when we were closing factories and society was just changing so rapidly. Jacob, you talked about the coal mines in Thatcher, right? And the chaos that it caused, I think, in northern England.
Particularly the northern side of England, where it was a lot cheaper to start to import coal and energy from other countries into the UK, and it just basically destroyed the whole northern England.
Absolutely. Well, that's what happened in Australia as well, right? And America, and that's why you've got those rust belts in America, and you've got a lot of people who are disaffected with mainstream economics, right? But that's and what. To avoid that, Japan and China, who are big manufacturers, and also to a lesser extent Germany, what they've done is said, well, look, if the US is sort of closing up shop, what we'll do is we'll make our currency even cheaper. And that's what they've succeeded in doing for the last 30 years.
But to what benefit is that?
Well, because, Tom, the idea is all capitalism is the same, right? We all should just be like America. Well, Asia doesn't think that way. Neither does Europe. And so what they're saying is, listen, we think employment is really important. Now, if you want efficiency and stuff, well, that's good. Yeah, we understand that. But we don't want 10% unemployment. We want to try and keep people employed. So in particularly Asia, what they do is say, well, look, we don't want Tom to be employed. All right, well, give him a job as a lollipop man outside a shopping centre where he's absolutely no use at all, but he's employed, right? That's the whole idea. So whereas in Australia we go, well, no, we'll sack Tom and we'll get one of those, automated gates, right? Boom gates. You go to Japan, you will see old men with, batons guiding traffic into shopping centres. It's complete waste of resources, but they're employed, right? And that's what they focus on. And because they've got manufacturing, you've got to remember, once you build a factory, it's not like a piece of software you can go, oh, we got that wrong. Oh, well, just dump it and we'll start again, right? You've got billions of dollars of investment that you can't move. And so what these countries are doing is saying, well, we really need to, how do we keep selling all these EVs into America? We'll reduce the currency, right? Because that will then keep us employed. And that's what's been going on for 30 years. And that's why the US has sort of, particularly with Donald Trump, said, right, that's over, right? That's over. We're going to start doing our stuff ourselves. So with the Inflation Reduction Act, Biden is building, Intel, Samsung, Taiwan Semiconductor Manufacturing Company, they're all building facilities in the States, right? Absolute cutting-edge high-tech facilities. They won't be pulling them down in 5 years, right? And that's the really important point, because now America is acting like China by saying, remember we were talking last week about Apple, right? Well, America is now saying, we don't want TikTok, right? We don't want your EVs, right? We don't want Huawei in here with any infrastructure. It's all going to be American. That impacts China because China's export focus is now, like, oh, actually, we're not selling those EVs. Okay, well, we got 30,000 Chinese in a factory that we need to employ. What do we do now?
There's
Right?
nowhere else that they can sell them because it's too expensive to export them elsewhere.
Well, yeah, everybody is now saying against, Europe is taking action, right? And the Chinese are doing a tit for tat. So the problem is not going to be for the Americans. The problem is going to be for the Chinese, because they're the ones that have had these unproductive sort of excess workers. And that's where the Chinese are going, well, hang on. Well, let me give you an example. China can make 40 million cars a year. Their market is 25. So in other words, they've got 15 million cars that they've got to export, right? Now, if Europe says, don't bring them here, sport, and the Americans say, well, you're not bringing them here either, where are they going to sell them, right? 15 million. Australia's car market is roughly about 1 million cars per year, and we get most of ours from Thailand and Korea and Japan. Now, we do get some from China, but you know what I mean? If you've got 15...
It's a small percentage.
Well, yeah, you'd say, we need 500 million people that are going to buy these extra 15 million cars. If they don't, well, we're going to have to get rid of these factories and close, sack workers like we all did in the 80s. That's the really, really big shift going on, right? That's why it's a really serious trade war.
I think as well as all that as well, we're in a period of time right now where a black swan event is more likely to happen than it ever has been, really. So other than that potentially happening in the US or anywhere else in the world, it's really all systems go, particularly in the US anyway. But I think what I want to highlight particularly is that we're in a time at the minute where there's just that much conflict and uncertainty that a black swan event, if it was going to happen, it would be around now.
And they, for some reason, always seem to appear at market extremes.
Yeah. Well, because you've got extremes all over. Everybody's irrational exuberance and people are going batshit crazy buying stuff. And so the setup's there for something to happen. And there's you can't tell what the event is going to be. And the other thing, which is really even worse, is it doesn't have to be a big event. It can just be a little event
that scares a lot of people.
That creates the downside. And that's what makes the market hard to predict. Like we've been saying, Cape's been high for a long time. Yep, we understand that. But and people will say, well, mate, everything's really good. And it's like, well, of course, it's always good before it falls down, right? It's darkest before the dawn, all that sort of stuff. But we can't tell you what the event is going to be or when it's going to happen. But what we can say is, again, every time it hits this level, there's been a really awful, collapse. Or, like we're saying, it's a 64 to 82, going to be a long, slow grind down, right? But we might have a 25% decline in there at some stage. So, they're decent sort of declines.
Yeah. Something that interests me, and maybe the listeners as well, but there's trends in the market that keep coming up, and the one of them is sell in May and go away. The other one throughout December and January was the Santa rally.
Yep.
Let's just talk about what sell in May and go away is or has been in the past, and what it means for investors, or at least what you can see in the market trends anyway.
Well, historically, May is a month where the market doesn't perform very well.
It's sort of
that seems to be pretty consistent if you go back and look at the last 20 years.
It's like a period between May and
November,
October-ish
I think. They call it seasonality, which is, I think it's November through to April or even May is the best 6 months of the year, and that includes the Santa rally, right, and the January stuff. The worst 6 months is May to November or end of October. But if you have a look at it, it's usually pretty bad in bear markets. So remember in the last episode, we were talking about the 5% dip.
Yep.
And if you buy it when the Cape's 12, excellent. But if you buy it when the Cape's at 33, then one of those 5% dips is going to turn into a, 20 or 30% fall. So it's a little bit the same with sell in May and go away. The bad times are when the market's really expensive or when it's in a secular bear market, right? October always jumps out at me. September, October always jumps out at me as being particularly rough. And a lot of it's just got to do with money flows. It's the American summer. Everyone's on holidays. They're not that interested in the market because they're at the beach and that sort of stuff. But it is a factor that,
should be considered if you're...
Would it determine, let's just say it's normal, it's a normal year and nothing crazy is going on. Would it determine your asset allocation?
Not really. Well, it depends, Jacob, if you're doing, if you're doing a 10-year strategy, there's a chart that goes around that shows, and some traders do this, they only invest between November and April. Right.
Okay.
And the argument is, there's a chart that goes around. If you'd have done that from, 1950 or something, you'd have made 2,200%. And if you did only the bad months, you'd have lost, 240% or something. So it's a really stark difference.
Yeah.
But it's, again, a lot of these things, when you look at them, they've got to be repeatable. Right? And what I mean by that is, if you do that strategy, you've got to do it every year for 20 years to sort of get the result.
Regardless of the CAPE, regardless of the valuation.
Well, yeah, because it's like cards, like you can get dealt an ace and sometimes you just get a crappy 6 with it, right? And you go, well, that was a really shitty hand. But the next hand where you get an ace, you get a king and you make lots of money.
Yeah.
But my point being, you've got to do... you've got to get 30 hands with 30 aces to determine that you'll do well, right? Like you can't do it once and go, oh, that shit doesn't work because you got an ace with a 6, right? That's what I mean. Investing's that long-term journey, so you've got to look at the patterns over a long time and the number of patterns, so you can say, well, yeah, look, in 8 out of 10 cases this works.
Yep.
Right.
And I think where a lot of people get mixed up, right, is they jump between strategies. So let's say this year that's the methodology they wanted to take, and then next year they try something else. And by doing that, they actually miss out on the statistics that come with that strategy.
Yeah.
Because it's like you have to play the hand every time you get it. Otherwise, that's not the strategy.
Yeah. It's called, in stats, it's called the law of large numbers, right? And it's simply saying if something bad happens once every 100 hands, play 100 hands, one's going to be a bad one, right? On average. Now, you might get it the first hand, right? But that might be enough for you to go, oh, the stock market sucks. And so you don't invest anymore and the next 99 years are fantastic, right? That's the sort of tricky bit. And that's why I sort of talk about CAPE a lot, because generally we've got this band where we know it starts to, if you're investing when you start CAPE at 25, okay, well, be careful because, a look at history says, look, it might go to 37 or it might go to 44 like it did in 2000, but it'll blow up.
Yep.
Right? And that's what you got to realise.
Well, I think that coincides with Tuesday's section in the week that was as well, where it's showing how important timing is in terms of returns. So we've got a chart that we can stick up on the socials, 10-year annualised real return with dividend reinvested.
Or jump on and subscribe to the week that was. It's free now.
Oh, yeah, you can do that as well. Good. Well
and
done,
you'll see that in there. See?
Oh, good out there, Tommy. He's sharp, marketer. Yeah. Well, but look at that, Jacob. Look at the difference, like down the bottom, that light blue line, right? That's the difference. That's why we harp on about timing the market. Because if you look at the 30-year average, it's 8%, right, over sort of rolling 30-year periods. I look at it and go, yeah, I know the average is 8, but there's the 82 to 2000 bull market where you made 16, and there's the 2000 to 2010 where you made ZOT.
Yeah, so if you cut that out, that chart would go straight up.
But do you see what I mean? Like, if you said to me, oh, Steve, I want to put money in the market. Yeah, Tom, 30 years, 8%. Well, the CAPE's at 35. You're probably not going to make anything for 10 years. Whereas if you come to me and say, Steve, it's 1980 or 82, then I can say to you, look, you're probably going to do really well because the CAPE is low and the earnings yield is high. right? And again, that's why it's really important to understand these market cycles, because there's times when you shouldn't be in the stock market, right? Not 100%, right? You might have 20% in there, but like we say, well, investment properties might be cheap. Okay, we'll go and buy an investment property, right? Or gold might be cheap. Okay, we'll buy, Bitcoin. Okay, we'll go and buy some other asset that's cheap.
Or energy.
Absolutely.
Or emerging markets.
Exactly. But that's that's exactly right. Right? Energy's really cheap. Okay, we'll go and buy some energy stocks. They'll deliver 6 or 7% in a dividend. You get 2 or 3 growth. Well, now you get an 8 or 9. Right?
Not financial advice.
No, but emerging markets, the same thing.
Wednesday, it kind of recapped. I know we focused a fair bit on this last week, so probably won't harp on about it too much, but just kind
Apple
of...
ain't apples?
It's about Apple ain't apples. Look...
They're oranges.
Look, he hasn't even missed a beat.
Many manufacturing companies will be shifting from China as de-risking take place, generating increased cost of moving facilities, but also higher long-term labour costs. And then there's a link to a Yahoo Finance article there where Tim Cook he toured Southeast Asia last week, visiting Vietnam, Indonesia and Singapore as part of a multi-day trip geared towards reducing Apple's reliance on China.
Exactly.
As its central manufacturing hub. So
There
go
you
check
go.
that
Told
out.
you
Have
so.
a read.
Ding, 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 ding. Told you so, moment.
I feel like he read this before he told us so.
Who?
Is that
You.
Stephen?
Well, that's my bloody job. What's that article about? Oh, bugger if I know. I just put it in there.
Keeps reading Facebook and posting articles telling us I told you so. Thursday, bull markets. Probability of a positive return was lower during the May to October months, which is what we've been speaking about.
Spoking about.
Been
Righto.
spoking about it.
Spokesperson.
And the November to April months are obviously a lot better based on the past.
Yes.
Bear markets saw much lower probability of positive returns during May to October months, but also bad in January and February. So that's literally what we've been speaking about.
Yeah.
Sell in May and go away.
It's basically the difference between secular bull and bear markets. And how do you do that? You do that by valuation.
Yeah.
Right, 82, the Cape was cheap. We had a secular bull market that ran to 2000 when the Cape went from 5 to 44. Then we had a secular bear market, blah, blah, blah.
And rinse and repeat.
And that's why it's really important to understand that stuff, because you read, I'm harping on about it, but that stuff about, sell in May works every week. And it's like, right, and you look at it and go, well, actually, no, it didn't work. And it's like, yes, because it was a secular bull market, right? That's the main point. Right, you always say to yourself, where am I in the market cycle? Am I in a bull or a bear market?
It's the first question you ask yourself every time you want to invest.
Absolutely, because then you go, okay, now I'll adjust my asset allocation. And from there you go, well, hang on, Jacob, you're in a secular bull market. Don't worry too much about rebalancing.
Careful you don't make it sound too simple.
Well, it is simple.
Aren't you meant to mystify it?
Yeah. Pay me money and I'll, manage your money for
I'll
you.
untangle it.
But that's what I mean. You've got to work out that context to understand whether you should allocate more, rebalance more often, that sort of stuff.
Yeah. Well, we got Friday, Tom. April returns.
April returns, as we've spoken about a few times, we're down for the month, but still up overall for the year. Most sectors fell. Energy spiraled even further. Utilities was at the top of the leaderboard for April, doing almost 5%. So putting us up to 8.3 for the year.
Is that us or the US? I haven't got my glasses on.
That is ASX 200.
Right, okay.
Yeah. Or S&P/ASX 200 sectors. So.
Right, okay. Yeah, I think utilities was the only one that did any good this month.
Yeah.
I think April was down for most things, wasn't it?
I think so, yeah. But that's, again, the US stuff. It's tax time and, that draws money out of the markets and stuff. So,
but it's still, it just shows, right, although energy is having a downturn, it's still cheap in the grand scheme of things, along with emerging markets and utilities. They're still decent sectors.
Well, there's still great dividends on offer in energy.
Yeah.
Yeah, and that's, again, what we talk about the new normal is everybody wants to talk about the capital gain. right? Everybody wants to talk about the capital gain, not the income. And that's why it's really important to understand that stuff, because if we're moving to a world where there's not going to be much capital gain, you're going to want to be where there's a lot of, or, a decent dividend and income. And if you get in it now with energy and you get, the bonus is the capital gain, well, you do really well.
And the price you paid so low, right?
Exactly.
Like, this is what stands out to me. Like, if you're getting something cheap and it's paying a dividend that high, the chances are you're going to also get an outrageous capital gain is also extremely high. Like, was it Triple O? What was the one that you recommended ages ago that naturally I didn't buy? Well, there was one that was paying like a 20-odd %
Oh,
dividend.
that was Triple O, yeah.
But you got to check on the quality of that dividend, though. It might not be.
Well, Triple O is a bit different. It's a leveraged ETF with oil, on oil futures and stuff. But yeah, it smashed it out.
That's ridiculous.
Well, but a better example,
And it grew in value.
A better example is Petrobras, right? Now, Petrobras is paying an outrageous dividend. It's really cheap and not investment advice, but when we talked about it, it's now up about 60%.
What's an outrageous dividend?
10, 11?
Yeah, it's nuts.
Well, it's better than poking the eye with a sharp stick, as my old man would say.
Not wrong.
No,
Look,
well.
in the bonus section, US deficit is projected to remain quite large, which should stabilise the economy and keep growth moving. But these periods usually are not that beneficial to stock returns. So
Yeah, just the reason why I put that in there is because people think of public debt the same way they think of private debt, and it's wrong, right? It is straight up wrong, and this is where lots of economists get it wrong. The government can't run out of money, right? Because they create the money. So it's impossible for them to run out of money. That's just a bloody point of logic. The impact is it may be inflationary. So if the government spends an absolute bucket load of money and causes, full employment, and there's a resources shortage and everyone's demanding iPhones and, oh my God, we haven't got enough staff to build iPhone, the price will go up, right? That's inflation. So that's what the concern is. A lot of the concern, and the Americans are really nutty about public debt because they see it as a contrast to private debt and freedom and all this sort of stuff they go on about. But if you look at it even in Australia, most people who are invested in, for example, property are really heavily leveraged. Well, I'd be a shitload more concerned about that than I would be about the government running out of money. So but what you do over history, Tom, is you get from 1945, right, the government have just spent a bucket load fighting a war, right? The war's over in 45. What do you see? The government debt declines, private debt rises. Private debt rises and peaks, and then they go, righto, now the private debt's got to fall, and the government debt picks up and rises again. So like we were talking about the bull market in 82, the explosion we got there was in government debt and private debt.
Right, okay.
And that's why stocks and stuff and property have absolutely gone gangbusters, because everybody, even the government's borrowing a shitload of money, so that's good for stocks. And people like you and I are all out there borrowing for, property and all that sort of stuff. So it's creating huge asset prices. My argument is in Australia, this is just Australia, the government debt in Australia is miserable. It's like 35% of GDP, right? It's tiny. We've got heaps of leeway to spend lots of government money. But the private household debt is huge. That's where we're going to run out of people to borrow money. And what happens? Well, prices will fall unless the government steps in. But if the government steps in and says, I'm going to build a bridge or I'm going to build factories, that's not giving you money to go and speculate on property. You see, so there's a big difference between public debt and private debt. And it's not, we've got it ass backwards because people go, oh, I'm really worried about public debt. Or economists sort of say, you should be. The reality is you shouldn't be worried about it. You should be worried about private debt because that's what crashes, that's what crashes markets.
Yeah.
Right? When everybody goes, oh, God, I've got to sell some of these stocks. So it's like the margin loan stuff, right? It's all really good until it stops, and then it gets a bit ugly, and everybody's got to sell down
and start scrambling to get out of it.
Yep, exactly.
Yeah. Okay.
Ciao.
Chart of the week. So we've got the usual suspects, cherry picking starting dates and using annual average returns, which obviously makes those returns look a bit more attractive than the real results. That's how they sell their courses, isn't it? That's what we should start to do.
Yeah. Cherry pick a date.
Yeah. So investment returns depend on when you start and when you finish. Average returns don't apply to all of us as individuals, because you could start in the 80s and I could start in the 2000s, and then they're totally different start and end points.
Yep.
So what we've got here on the something that the listeners are definitely not looking at is the stocks, bonds, and cash annualized returns. Stocks are at 10.1% from 1994 to 2003, and that is a 2023, sorry, and that's mostly a bull market the whole way through, other than the GFC.
Yeah, and the 2000, the 50% decline.
And the tech bump.
But my point being, you look at that and go, wow, man, 10% per year, that's pretty good. Yeah. And then when you look at the real return, you go, oh, actually, that's not that good, because you take out inflation, you take out the volatility, right, which, as I said, the RBA did the study in 19, right, where it said 8% is really 6.
Yeah. Well, you might have done 10% from 94 to 2000, so 60%, and then you got a 50%
Absolutely.
And you're back at 10.
Well, perfect example. From 96 to 2000, you did 100%. From 2003 to 2007, 100%.
Yeah,
that's fantastic. Well, not really, because in the middle you had 2000 to 2003 where you lost 50%.
Yeah.
So in other words, you lost everything that you made from 96 to 2000. You lost from 2000 to 2003, so you're back to start. Then you go 203 to 207, you double again. So you go, this is fantastic. 07 to 09, lose 50%.
Yeah.
Right? That's what I mean. That's what you got to look at.
Excluding inflation and all of that.
Absolutely. So you
costs
look at
and charges.
The old asterisk down the bottom of the page.
Yeah.
So that's why I say it's really important to understand where you start and where you finish. And I think I said this before, if you start at a cape of 10, well, you're going to get a smashing return, much more than when you start at a cape of 35. Now, that's over 10 years. I'm not saying I don't know what's going to happen in the next 12 months. You might still boom. But my point being is, if you're a long-term investor, you want to buy when things are really ugly and really cheap. That's where you get the good returns. And that's why energy, Tom, is, looks really attractive. Why? Because nobody wants to buy energy. They all want to buy NVIDIA and, Apple and blah, blah, blah.
Yep. No, that makes a lot of sense. Look, just quickly before we wrap up, just a gentle reminder, we've now made the week that was available to everyone. So if you want to jump on our website, you can subscribe there for free. You'll have it delivered every Friday. The other thing worth noting, we've just released a month free for Investing Essentials. So if anyone wants to jump onto that, you're going to get access to the masterclasses, and we've done a new free short course as well. Which will include things like market cycles, risk hierarchy, asset allocation, rebalancing, financial fibs. So you can jump on at the moment, check that out for free. Let us know what you think, and thanks for listening.
Awesome. Thanks, everyone.
Cheers, folks.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.